Welcome. Today we're going to go over 3 ways banks, lenders trap real estate investors into paying more than they should. We want to make sure that you're paying the least you can to make investing easier. If you're new to this channel, I'm Mike Bond, and we're here to give you the knowledge that we've obtained to make you the best investor you can. Because we want to make sure you make the money you need to live your best life. To do that, make sure you like, subscribe, so you can watch other videos just like this one. So why do investors end up paying 1 to 4% more for their loan, or 5 to 10% more down on a property, or even being declined on a loan? Those 3 traps come back to what we call the usage circle. So what is this usage circle that we call, and how does it affect real estate investors? Well, here's how it goes. A real estate investor uses their credit cards to keep a project going, paying for materials, paying for labor, and or just paying for materials and knowledge to get them where they're at. Now, all of this is going to be paid off on the next transaction when they actually close or refinance a deal. Their credit's going to be wiped out, their usage is going to go down, and their credit score is going to go up. The trap occurs because banks are not going to use their credit score in the future. They're going to use their credit score now. And because they're using their credit cards to keep their business going, it's keeping their credit score down. So you can see where the trap is. They're buying stuff that they need to keep their business going. It's bringing their credit score down. That means the bank is going to offer you a higher interest rate, or they're going to require you more money down, or even decline you. You know the difference between a 679 credit score and a 680? That means you're declined if you're at 679 for a conforming conventional investor loan. The trap that I see most people are is they're using their credit to keep their business going, keep their projects going. The usage in a FICO score equates to 30% of what makes up your credit score. It's the second highest factor in your FICO besides making payments on time. So if you're not making payments on time, this doesn't matter anyway, but if you're making payments on time, the biggest factor we see in real estate investors is usage. And this usage circle, like I said, comes back to you need to use the credit to keep your projects going. You will pay off that credit when your project is done, when you sell it or refinance it. But you need to get credit now, maybe not only for business, but personal. You need to buy a car, you need to refinance your home. It all counts against you, and the banks know it. They know as soon as you pay off those credit cards, your credit score is going to go way up, but they don't take that into account. So what does this mean to an investor in real terms? Where do the banks trap you in these 3 items? Number 1, if your credit score is down because of usage, it's going to cost you somewhere between 1 and 4%, either on the interest rate or on loan costs. So what that means, on a $400,000 project, you're going to pay somewhere between an extra $4,000 and $16,000 just for that one transaction. Now, what happens when people do 3 or 4 transactions a year? You can see how this stacks up. The other way it affects investors, and it's typically the investors we want to help. It's not the large funds, it's not the capital corporations out there. We want to help middle America. We want to help you get the money. The other way they keep you out of investing is with your credit score down. Now they're going to require 5 to 10% more on a property. If you have to put 10% more than someone else on a $400,000 transaction, that means you have to bring $40,000 out of your pocket, out of your savings, into this transaction. That may just cause you not to do this or be able to afford to do this. Third, maybe they just deny you because your credit score is 1 point off. They need that 1 point to actually fit their guidelines. That means you may not be able to do a deal. Maybe you don't get that rental property or that flip, and you have to sit on the sidelines. The credit score usage trap is real. It happens to almost 80% of the clients that we see. They get trapped in a cycle, and we try to help them out of that cycle with using these solutions. So the solutions all revolve around one thing, and that's getting your personal credit cards off of your business use. In other words, stop using your personal credit cards for business use. You need to move these over to business credit cards so they're off your credit. So the next time you go to get a loan for your business, your credit score is not impacted by the credit usage you're using for that business. Or if you're just going to get a car loan for personal use or your home loan, it's not impacting if you get a loan or what you're paying for that loan. Our goal here is to make sure you're setting yourself up to win. And that means you need to start moving your credit cards over to your business so they do not report on your credit card. So here are the solutions we help people with. And actually, since we're in business, we do some of these also. So number one, if you have an LLC already set up, you're already working as a business, and your usage is causing your credit score to go down, what you need to do is take that credit card balances off your credit by using a private loan. That means going to a family, friend, or someone to pay off those credit cards, let them cycle through maybe 30, 60 days, maybe 90, so your score could go up. During that time, you apply for a business credit card and move those balances over to a business credit card. So if you don't have family or friends who could do it, we do this all the time for our clients because we want to see them get the best lending options they can, and most of it requires a good credit score. Our second solution, now if you already have an LLC and your credit usage is not bringing down your credit score, is to get those business credit cards, the ones that do not report in your credit cards. There are some credit cards like Capital One that will give you a business card, but it'll still report in your personal credit. That defeats the whole purpose of doing this. Remember, we're trying to get these off of your credit because it is the number one reason that credit scores decline besides just lack of making payments. And we want to make sure you get the best rates, the best terms, everything you can to make this investing easier. So what we've done is we've provided a link below, one that we use ourselves to get business credit cards. Just look for credit cards that you could get that are on your business name that do not report on your personal credit. If you use it and you get the credit card, we're going to give you $250 off your next loan you do with us. It's a win-win situation. We would not do this if we did not believe in it. Our whole goal here is to make real estate investing easier and more profitable for you. These little tricks, these little tools will help you do that and become the most successful real estate investor you can be. So we're going to come out with other videos all around helping you become more successful. So check out this channel and we'll see you on the next video.